The topic of Houston and the trajectory of the commercial real estate market this year and in 2016 has been on the lips of every real estate investor in the country, and in a lot of cases internationally as well. So our local team has been very popular, maybe not for the best reasons for the past year or so, and our outlook is pretty sanguine. There's a lot of headline risk that we're constantly challenged with from people from outside the market who may not understand the way that we operate, and so in forming this 2016 outlook that they invited me to present, I thought it would be helpful to talk about a little bit of history before we talk about the future. So the first thing I need to say is HFF is a publicly traded company, so anything I say you can't use for investment decisions, okay? So in talking about how optimistic we are about 2016, I'm going to start by talking about one of the biggest corporate malfeasance cases in U.S. corporate history. So I don't want you to mistake my tone. But I'm going to use it to show you why in Houston, Texas, we don't need to be building an ark, right? There's not a draconian set of floodwaters about to destroy our commercial real estate market. Things here are going to be a little bit challenging, but on balance, they're going to be healthy, and we need a period of some calm, if you will. So let's talk about Enron. In 2001, in late 2001, Enron filed for bankruptcy. They had tens of thousands of employees that were laid off literally overnight. They had an enormous skyscraper in downtown Houston that was vacant overnight. And shortly after the bankruptcy, they delivered their second building. So in December 2001, we had about 4 million square feet of vacant office space available when Enron filed for bankruptcy. And that was the start of a 4-year hangover for the local commercial real estate market. At the peak, the local office market had about 8.6 million square feet of vacancy. And that peak in vacancy was in July of 2003. So at that time, we redesigned the Enron logo to be a giant middle finger. Right? So by late 2005, the clouds are starting to part for Houston, right? And we started to see an expansionary period in the local real estate market that was principally evidenced by what was happening in the office market in particular. Starting in this period that's highlighted on the screen in green called rapid expansion, we had a burn-off in vacancy, and rental rates started to rise, right? And we saw a big pop in rental rates. Mainly, a lot of landlords were able to convert from gross to triple net rents overnight, right up to the end of 2007, and then in March of 2008, Bear Stearns was sold to J.P. Morgan for $2 a share, right? And this is a $2 bill taped to the window of Bear Stearns headquarters in New York City that very day. So that was really painful, right? That was a lot of headline risk in the national and global economy, but in my perspective, it saved Houston from a meltdown. What I've got on this map are 8 developments that HFF was working on in February of 2008. Not a single one of them got out of the ground, right? So the weakness that we experienced in the wake of the Enron crisis prevented us from being able to keep that vacancy low, ramp up those rental rates, and then start speculative development that would have been delivered into the financial crisis, which is what a lot of our sister cities around the country experienced, right? So that was Enron is what I'm talking about. That was a governing event that really kind of saved our rears. So I see a little bit of that going into 2016. This is a very technical graph. This is data that comes from a group called the National Council for Real Estate Investment Fiduciaries. What does that mean? It's basically institutional investors investing money for someone else. So think about pension funds, insurance companies, et cetera. We're the green line in Houston. So you see the green line, and this is capital appreciation of real estate assets. It surged in 2007, right ahead of the financial crisis. So we lagged the other markets, the other gateway markets that are here on the page. San Francisco, LA, Denver, Chicago, et cetera. Right? Then we had a shallow correction in 2008 and 2009, and then we came out of the gates really, really hot in 2010. Our capital appreciation of our local real estate assets has been on par with San Francisco over the past several years. Right? We need to cool off. We need to let some of these other markets catch up. So I don't see a scenario where the green line starts to crater and go down towards the other markets. I see us plateauing and the other markets catching up, which is a reasonably healthy environment. So I just want to point out that over the past 9 years, the Houston market has added almost 800 basis points of extra return on an annual basis than any of those other markets on average. So things have been really good here, right? And we all enjoy that. And that they're not as good anymore makes a lot of people nervous, but it could be a good downside scenario. So looking at transaction volumes in the office space, 2015 is the orange shaded region. This is transaction volumes throughout the year compared to other years prior. The office market didn't see a whole lot of velocity in 2015 relative to what was experienced in 2012 and 2013. So Danny Miller's in the room. He works at HFF here in Houston, and he's done some good analysis with Justin Boyer, our local research associate. And the idea here is over 40% of our office stock has traded hands over the past 4 years. So you have a lot of owners that are in the first couple of years of their hold period. They don't have to sell. In fact, they're in the middle of a business plan. So we're not going to expect a lot of transaction volume in the office space for the next couple of years, and that's okay, right? In the multi-housing sector, the numbers are a little bit better relative to prior periods, but we're starting to see a little bit of a plateau in transaction volumes. The industrial and the retail space are doing really well. I don't want to steal all the thunder from Jonathan and Trey, but the retail sector in particular is doing really well, and the reason for that is because we haven't had a whole lot of construction in the commercial real estate space in retail. I think there's less than 3 million square feet underway, and on a base inventory of almost 300 million. And I looked up sales tax receipts this morning. Houstonians, the Houston MSA, Houstonians spent $52 billion at retail stores in the first 6 months of this year. That's down almost 10%, right? But the price of oil is down 70%. So we don't see a nasty scenario coming to play. The other promising thing that we recently learned, and again, this is Justin Boyer's good work in our office, is taking the average earnings of a Houstonian and adjusting it for the cost of living and the housing value. Houston, as of September of this year, in an environment where the price of oil is in the 40s, still has the best bang for your buck in the entire country, right? So we've got a lot of spending. So has that scared off investors? Not necessarily, particularly in the foreign front. This is a map of where we see foreign capital flows coming into the Houston real estate market. The behemoth here is Canada. Canada has always invested in Houston. They probably always will. But the new entrants to the market are Israel and Asia, right? Particularly South Korea. So our team spent 10 days in China in August when the Shenzhen and Hong Kong stock bourses were crashing, and they had just devalued their currency, as they did again yesterday. And the conversation was, how are devaluing currencies and slowing economies going to impact capital flows? They're not. They're accelerating them. People want a dollar denominate, and that for Houston has been fantastic, and we expect that to continue. So what do we expect? There's a lot of headline risk, as I mentioned. We have layoffs in the manufacturing sector, in mining and logging, and now in some skilled labor practices. Manufacturing here, we have more manufacturing jobs here than any other city in the country. Just want to point that out, although we're losing some on a year-over-year basis. But that is the petrochemical industry and steel drill pipe. So we're not really losing jobs in the petrochemical industry, we're adding them. So all these losses are related to building steel drill pipe that are used in rigs. In the mining and logging space, it's support activities for mining for oil and natural gas, and then for professional, scientific, and technical, this is where you see some attrition in engineering. So one of the big growth drivers for Houston going forward is construction, and when I say that to a group of people such as yourselves, people think about apartment communities, office buildings, retail centers, but really where we're adding a lot of construction jobs recently is in the petrochem industry. There's almost 100 billion of projects along the Gulf Coast that have been identified that are underway. Unfortunately, these are going to be relatively short-term, 3 to 5 years, but this is really providing a floor to Houston's economic performance, at least in the job standpoint. So one of the last few things I want to do is compare Houston to the rest of the country. And I think it's important to show that since year-end 2014, we're relatively flat in terms of employment. Over the past year, I'll tell you on the next slide that we've added 30,000 jobs. But since January 1, we're flat. The rest of the country has grown at about 6 times our pace. So for me, this looks like a great downside scenario. For me, this takes beta out of the market. It takes risk-taking, over-leverage, developing real estate when you're underwriting 100,000 jobs a year. We needed to remove that type of activity from our market if we weren't going to set ourselves up for a major correction. So as the research guy, this looks great. right? It's not fun for developers. It's not fun for brokers like HFF. It makes the best brokers and the best developers have a little bit more competitive advantage, right? And it makes them important in terms of being able to work out a deal when the bid-ask gap can be a little bit sizable like it is. But this, to me, is healthy in terms of a correction. As I mentioned, we're 33,000 jobs over the past 12 months. And typically in November, and this is through October, typically in November and December, we add jobs as retailers build up staffing for the holiday season. So that should continue this year. As I mentioned, retail sales are still really handsome. So my number, and this is Jimmy Hinton is the source on this slide, my number is 33,000 for the year. And I think that number will be higher in 2016, but it's going to be back-end loaded. I think the first 6 months of 2016 are going to be relatively quiet until we get a vision of what happens in Washington, until we figure out what happens in the Middle East, and as we digest what happened with corporations in the M&A space and with earnings in the first quarter as we figure out year-end earnings season, what happened there. One more thing I want to point out, and that's population growth. Population growth here is agnostic to the price of oil. This is growth over the past 4 years, I believe. Is that right, Justin? 4 years, since 2010. Houston is #1 in aggregate population growth. And a lot of people that talk to me and are not from Houston go, well, you should be growing by 500,000 people over a 4-year period. You're one of the largest cities in the country. And I challenge them and say, all right, look at the orange dot. That's our percentage growth. It's the highest across all of these markets, only behind Austin, right? So we're adding about 100,000 new residents to the city like clockwork, right? And that has unbelievable accretive forces on demand for housing, retail, healthcare, et cetera. So all that impacts real estate. So what am I going to do in 2016? I'm going to party like it's 1999. Our rate of job growth declined, right, to about 1% as it did this year. The rest of the economy continued to chug along. Unfortunately, we had a national recession take place in 2000, 2001. No one that I talked to that's an economist, I'm not a PhD, right, but all the smart people that I talked to are not anticipating recessionary forces in the U.S. in 2016. So we're going to poke along somewhere between 1% and 2% in terms of job growth in 2016, and the rest of the national economy is going to support accretive activity for our local economy as well as population growth. That's what I got.